The Invesco S&P 500 Momentum ETF has been incredible. One of the strongest momentum performers in the entire ETF market, one of the best risk-adjusted returns that you'll see. It's the kind of ETF that when you look back over the past 10 years, you say to yourself, man, I wish I had owned that. But here's the thing, the market changes. And so the question is SPMO or SPMO structured so that it's going to be the best going forward? Because there's a lot of different momentum ETFs. Well, in this video, we're gonna talk about another fascinating momentum ETF and see how that stacks up against SPMO. We'll be going over SPMO's amazing performance. We'll be comparing it to FDMO or FDMO, the Fidelity Momentum ETF. Then we're gonna go through my ranking process, which is going to show you which one of these comes out on top. So essentially there's going to be a clear winner. And I'm gonna actually show you how to do this with just a few clicks of a few buttons with my web app that's free. We're gonna need to talk about Momentum 101 because to understand how these ETFs are going to do going forward, it's important to understand that. And we're also gonna talk about how and where FDMO beats SPMO. In order to put this into perspective, to understand just how good SPMO's performance has been over the past, let's say, 3, 5, and 10 years, I'm gonna compare it to some other ETFs so you can kind of understand. So first off, we have a 22.1% return for SPY, or call it VOO, or the S&P 500 index. We're gonna call that the market. So if you beat this number, you beat the market, essentially. So 30.0% is SPMO. So trounced the S&P 500 or SPY. Now, Triple Q also had an amazing return, 31.3% over the past 3 years. Next, over the past 5 years, with a 15% rate of return, we have SPY. Following that, we have a 16.5% rate of return. Which one do you think it is? It's actually Triple Q, which means that SPMO over the past 5 years had an annual rate of return higher than Triple Q with a 20.1% rate of return. It looks amazing, right? So then we go to the 10-year return, 14.7% SPY. We got 17.9%. Which one do you think it is? It's actually SPMO, 17.9% rate of return over 10 years. It's crazy. And then over 19.6% return over 10 years for Triple Q, which also, is crazy. Now, just so you know, SPMO had this rate of return with lower risk than Triple Q. So you took a bit more risk with Triple Q and you got higher return. But now let's compare SPMO to FDMO. We're gonna circle back to the returns later, but we're gonna go to expense ratio first. So expense ratio at 0.13%, 13 basis points is SPMO. Then we have 15 basis points or 15.15% for FDMO. So very slight difference in the expense ratio, just a little bit more. Now, if we talk about risk, we're gonna talk about two things for risk. We're gonna talk about the max drawdown and we're gonna talk about the volatility. Max drawdown, when we look back to September 15th of 2016, what we're doing is we're saying, okay, if you take these two ETFs from a peak, how high they got, to a trough, how much did they fall? It could be over any period, it could be over 3 months, it could be over 3 years. It's just what's the amount that they fell from a peak to a trough. And so what you get is a negative 31% for SPMO. Seems like a lot, of course. So then you come up to a negative 33.9% rate of return, or say max drawdown for FDMO. So slightly more of a max drawdown for FDMO than SPMO. Now let's take a look at the volatility. 17.6% volatility for FDMO, and then 18.5% volatility for SPMO. So you got a little bit more volatility for SPMO, but you got a little less max drawdown. Let's look at the size and the diversification of these ETFs. So for diversifications, like how many holdings are in them, you have 101 holdings for SPMO. Now remember, this picks from the S&P 500 index. So there's 500 eligible companies. SPMO goes with 100 of those. They're going to be the highest momentum 100 stocks, which we will go back to later and talk about when we talk about Momentum 101. But this is generally the highest momentum. The ETFs both have like a risk adjustment in there too. So then FDMO has 129 stocks. Now FDMO is going to pick from a larger universe of companies. Call it like more like the Russell 1000 index, so like 1,000 stocks instead of 500. So there's a few more options for FDMO than SPMO. Next up, we have the size. So it's actually not even $1 billion under management for FDMO. It's $590 million in this ETF. And for SPMO, there's $13.2 billion. So definitely a lot bigger of SPMO, and these are not considered huge ETFs. Actually, FDMO is considered definitely not a huge ETF. Not a lot of assets under management in that ETF, actually. So now let's come back to the return. So how did FDMO do versus SPMO and all these other ETFs as well? So let's start with the 3-year return. So SPMO, as we could see, had a 30% rate of return, but FDMO had a 25.6% 8% rate of return. So definitely a great rate of return. It beat the market, it beat SPY having a 22.1% rate of return, but just not quite as high as SPMO. Next, we have a 15.7% rate of return for FDMO, also beating the market, but yes, not outperforming SPMO. And then on the 10-year rate of return, we actually don't have enough time. This hasn't been around long enough for us to tell. So FDMO is not going to have a 10-year rate of return. But based on what I've showed you so far, I'm going to go now and rank these ETFs with my free web app that you can actually find in the description below. And the way my web app works, you first have to decide if you're a passive investor, growth investor, or dividend investor. We're growth investors here. This is momentum. We're trying to beat the market, right? That's the goal. So we want high returns. We're going to compare this to SPY, SPMO, of course, Triple Q, and FDMO. So I add these and I hit this compare tool, and it basically takes all the information I kind of just went over and it now ranks it based on my proprietary ranking system. So you get SPMO on top here. SPMO is number 1. Triple Q is ranked number 2, SPY is ranked number 3, and FDMO is ranked number 4. There's a caveat here that you should actually know. So the thing with FDMO, it's not 10 years old. It's getting close, actually. You can see it's 9.2 years old. So by the end of the year, we're gonna have a ranking for a 10-year rate of return on this thing. But because there's not a 10-year rate of return, FDMO is not going to quite compete with these other ETFs because part of this ranking is a 10-year rate of return. And when you don't have that 10-year rate of return, it does tend to hurt your ranking. So yeah, maybe look back at this in a year and see what happens. And a quick side note, I just added some charts onto this thing. So there weren't charts before, now there's charts. So we got a returns chart and you can actually toggle this on and off if you want to just see FDMO versus SPMO. So these are the returns. So very important part, of course, is seeing the volatility. And so what we do is we could actually go here and sort the volatility. And so we could see Triple Q is the most volatile of these, then SPMO, then FDMO. So FDMO is less volatile than SPMO, but it's still more volatile than the general stock market, which is SPY. So now we need to have a brief overview of momentum and how it works and why it works. And what you're gonna see is that it really, really works, like empirically proven to work. And so you have to go back to a paper that was published in 1993 by Jagdish and Titman. And we're not going into super specifics here. Just know that that paper is kind of where momentum was discovered academically. And what they did was they used something important that we need to understand. 12-1 momentum. Now what is that? It takes the prices of all stocks in the stock market and it says over the past 12 months, which stocks had the highest return. And that's it. It's pretty simple, right? Take all the stocks, which stocks did the best. Now what you do is though, you take out the most recent month because there's a tendency in momentum stocks to after like the first month, they actually can kind of like crash and reverse their price. So you want to get rid of that last month. So it's 12-1 momentum. That's what it's called. Now what's crazy when you do this, when you say, okay, what happens to the best performing stocks in the stock market? So let's say the top like 10%. And then let's say the bottom 10%, even those, the bottom 10% on momentum, the bottom 10% of momentum continue falling. And the top 10% of momentum, they continue rising. That's why hedge fund managers like Cliff Asness of AQR, they will short the worst performing momentum stocks and make money on the downside, and they'll go long the ones to go make money on the upside. But we're not hedge fund managers, we're literally just buying stocks and holding them, right? So we're only going long these momentum stocks in these ETFs that we're looking at. In the paper from Jagdish and Titman, this worked everywhere. I think the name of this paper actually is like Momentum Everywhere or something like that. I'll flash on the screen later. And when we say like everywhere, it's like everywhere. It's in every different asset class. It's seen in every decade that they could test. It's seen in every country that they could find. It's everywhere, it's literally everywhere. And it goes against some people's ideas of investing, and it goes against my old idea, which was value investing is the way to go, and you're really just buying a stock because, let's say it's undervalued, the intrinsic value of the stock, whatever. You're trying to find out like what the company does, how much it should be worth, buy less for it than it's worth. Momentum's totally different. You don't even need to look at the balance sheet. You just say, hey, what happened to the price? It's weird, but it works. Why does it work? There's two potential reasons. Number one, you're taking more risk. So because you take more risk, you should be rewarded with more return. Okay, that's a camp. And there are people who are in that camp, but then there's another camp that says it's behavior. When stocks shoot up, they don't quite shoot up enough. So what you're really doing is you're buying something because it went up a lot, but there's still a lot more to go up because it doesn't quite reach where it's supposed to get to when it starts going up. Now, the same thing can actually be said about value investing. So you're buying stocks that are really cheap because you think that people actually overreacted and sold too much of the stock. So now the stock's down here, right? But you think it's worth this. So the stock's gonna come up and you're gonna make money. Well, momentum is kind of the same. Instead of people overreacting and selling too much, they're actually underreacting, right? So the price should be up here, but it's here. So what you do is you say, okay, I'm buying at this price because people underreacted, boom, it shoots up and it hits the price that you think it's worth. Now with momentum investing, it's very important to understand that it's not a buy and hold for a very long time type of strategy. You have to constantly be turning these over usually. And this gets into one of the great things about FDMO, and I wouldn't say great as in it's perfect, but better. And so let's talk about that. So for SPMO and for FDMO, we need to talk about rebalancing or reconstitution. So let's say going finding new stocks to put into the portfolio. When do you do it? How often do you do it? That's very important with momentum investing. As you can see, as you could like imagine, if you buy a bunch of stocks and you're doing it based on price, prices move so often and so fast that you don't want to be doing this like once every 2 years. That's not often enough. We're already looking at 12-1 momentum. We're already looking at a 1 year's time period. So once you get those stocks in the portfolio, you need to also be constantly looking at them essentially. And there are ETFs that do this even better than these two, but we're only talking about these two today. And the other thing is, FDMO has this thing called sector neutrality, which is, I think it's important. This can be a little hard to understand, but I'm gonna attempt to explain it to you. So let's think of it like this. So rebalancing, the main thing that FDMO has going for it is that it's rebalancing more often. So SPMO only rebalances every 6 months. And now when you're looking at real momentum or people who actually trade momentum or create portfolios of momentum the way that we're doing it in this, which is cross-sectional momentum is what it's called. You're looking at all the stocks and you're comparing them to each other and you're picking the top, let's say 10% of those stocks. Well, it's really good to be rebalancing your portfolio or reconstituting your portfolio maybe like once a month, maybe once every 2 months. Now, then there's like transaction costs and those things can add up if you're doing it yourself, let's say. But if you have an ETF, of course, you have like tax efficiency because it's inside an ETF. All the trading and stuff goes inside the ETF wrapper. You're not paying all the taxes for that. But you do want to have it rebalanced, reconstituted more often. Now, SPMO is at 6 months. What's good about FDMO is it's once a quarter. It's every 3 months. So it's more often. So if you do have something like, let's say, a big event that occurs, FDMO has the chance of changing up the portfolio quicker than SPMO. And to me, that's a big benefit of having FDMO over SPMO. And I'm not saying it's like the best one still. There's a lot of other momentum ETFs, and you might actually want to have a basket of momentum ETFs even. But maybe that's another video. The other thing, sector neutrality. Let's just go over this real quick. Not a lot of people talk about this. Not a lot of people probably understand what this is. So the S&P 500 index has certain sector weights. Let's say it's like 35% technology or something like that, right? So what if SPMO in a certain year, it finds a bunch of stocks when it reconstitutes and rebalances, and suddenly those stocks, there's no tech. So now you're looking at SPMO's performance and you're saying, okay, this is a momentum ETF. And let's say it does really well, but there's no tech. And let's say tech does really bad in a year. So SPMO basically got rid of tech because the tech names didn't have the momentum. And then let's say SPMO does really well. Now the question is though, did SPMO do well because of momentum, or did it do well because it got rid of a sector that's not doing well? And so when it comes to like understanding like pure momentum versus the market, you would want to sector neutralize your portfolio to understand if your momentum is really what's driving the returns, or if it's like sectors, sector risk or something like that, right? Sector rotation. And there's no really way to know unless you sector neutralize. So what you do is you say, I'm going to have the same sectors as the stock market. So if tech has 35%, I'm going to keep my portfolio as close to 35% as possible in the tech sector. And so that's the difference. SPMO, it doesn't care about having 35% in tech. It could go to zero tech. It's literally just picking stocks that have the best momentum. FDMO is making sure that it stays within that 35% of tech. So it's going to take like the best momentum scores inside the tech sector, weight 35% of the portfolio in tech, move on to the next sector and the next sector. So obviously the returns of SPMO have been better than FDMO. But I don't know if it's because momentum or is it because of the sector bets that SPMO made and that FDMO didn't make. And see what I'm saying here? It's kind of hard to understand which one's really better. If you're just thinking about momentum, if you want to see which the better momentum ETF, it's hard to tell. You could say the SPMO performed the best, but is it because of the momentum factor or is it because of something else? I'll let you decide for your own portfolio what's better for you. I'm honestly on the fence about the whole thing, which one's actually a better way to do it. So I'm not going to tell you which one I think is best. And actually, speaking of the best, one of the best growth ETFs, SCHG, is it actually better than SPMO? Well, take a look at this video and find out.